Hello and welcome back to the course, and in this video I'm going to take a look at one of the most very basic patterns, and it does have a little bit of overlap of support and resistance, the first two videos in the little mini course. This is a rectangle, and a rectangle, just as you would expect, has a flat top and a flat bottom, an elongated area of consolidation that continues going forward. So why do rectangles matter? Well, rectangles matter for the same reason that triangles do and many of the other shapes, and that's because they are common. And in fact, I would suggest that rectangles are probably the most common shape that you'll run into. And that's because markets typically consolidate. Depending on the market, it does vary a bit, but as a general rule, about 75 to 80% of the time. Well, by its very nature, that means that we form rectangles all the time. And you can see I can just go straight through the chart and find little rectangles as we go along. Now, some of them are a little bit more impressive than others, but they all mean the same thing, and they mean that the market kind of flattened out and it stayed in a range. So how do we use this to our advantage? Well, it's pretty straightforward, really. We can draw out some support and resistance lines, just as we do on, the support and resistance video. And here I would, for example, say 126.50. And that is the bottom of our little rectangle. And remember, I tend to try to use round numbers whenever possible. So it just makes things a little bit more simple. So there I would have 129. Although I recognize that it isn't perfect, you could even go 129.20. That might be a little bit better to what's going on. But 129 would be close enough for my purposes. Now, you can see we have formed a couple of highs here and a couple of lows here, and we continue to do that. So an interesting way to play this, and in fact, there are two different ways to play this. Some traders will go back and forth until the market breaks out or breaks down, because it'll do one or the other eventually, and they just play back and forth until they're proven wrong. Another way to play the rectangle is to take the measured move, much like in the support and resistance videos. So in this case, we could make an argument for it, say, 129.20 is the high. So let's just say we break out to the upside. You would have a measured move from 126.50. So what you do is you measure the distance, and it's almost 300 pips. It's a little bit shy, about 270. So that would be 129.70 plus another 200, 131.70. And when you go up to 131.70 roughly, that's right at the bottom here. So it kind of lines up anyways. And you'll see that time and time again in technical analysis. But, so that's 270 pips. But it means the same thing on the way down too. 270 lower. So if we were to break down below 126.50, you would just simply subtract 270 pips. So very easy to figure this out. Nice mathematical drive here, kind of aspect to it. So trading it, here's the thing. There are a couple different ways to trade this type of breakout or breakdown, and that's where things get a little bit more nuanced, if you will. Some people will trade immediately when we break out to the upside or the downside, and they just go ahead and follow the market. We do get the occasional false breakout, so some people will wait for a bar to close outside of this area. In this case, this is the daily chart. Whatever time frame you're dealing with, it doesn't really matter. It all works the same way. But if you get a daily close above here, then you buy it, and you sell it if it breaks down below. Now, you're aiming for the height, the measured move of the rectangle, but so when do you get out? That's the question. And this is a little bit nuanced as well. Typically, what you'll hear most of the time is people will put a stop loss halfway through. So by its very nature, on a breakout, you're aiming for about 2 to 1. It won't be quite perfect if you wait for the daily close because, it might be, say, 20 pips above. But that gives you a reasonable risk to reward ratio. For myself, sometimes I actually will do something a little bit different. I will go ahead and make this a different color, but I will do something along the lines of perhaps putting my stop loss at about a third. And then that way it's almost a 3 to 1 ratio. Yes, you do have the ability to get knocked down a little quicker, but I have found typically if you do dive down a good third, and most certainly halfway into this area, something's changed. The psychology's gone the wrong way against you, and you're better off just getting out. So, by its very nature, that gives you the ability to have a good risk to reward ratio, and I do highly recommend doing that. But there are some other things that you can do too to kind of pad your trades for a little bit. So, this is a 20 moving average on the daily chart. You can see that we have gone higher. We're starting to turn up higher as well. So, if we break out to the upside, it goes with momentum. The moving average itself isn't the signal. It just gives you an idea that the trend is starting to look more bullish, just as this rectangle up here that we had started to form once we broke down. The moving average had dropped, so certainly you would have had more of a bearish inclination there. Now, you'll also notice that not only do we typically get the measured move, but if it's with the trend, we may consolidate again and go even further. So, for example, on this shorting opportunity, we not only got that measured move down to about, about here, we went much further. But we want to take this one step at a time. You have to think of these as signposts along the highway. So here, currently, this is a live chart. Who knows how this turns out, but if we break out to the upside, I measure that move for 270, right about there or so. And if we break down, I measure that move for about 270. It's just a matter of letting the market tell us what to do. Again, though, there are range-bound traders that will just go back and forth and then take the loss whenever it happens. Two different ways to play it, but certainly the rectangle is probably one of the most important formations because it's one of the most common. It tells you the market's taking a breather. Typically, though, they say that consolidation, which a rectangle is, leads to continuation of the previous trend.